Look at the screen. Focus. Are we clear? Good. Because if you own silver, if you own gold, if you own even 1 single ounce of real metal, do not sell, do not trade, do not even think about hitting that button until after you finish this video. What I'm about to show you changes the rules. Permanently. Right now, while you're watching this, something has broken. Not bent, not stressed. Broken. And the people who rely on you not noticing are praying you scroll past this like it is just another market update. It is not. The paper price says one thing, the physical market says another, and the gap between them just exploded in a way that should not be possible in a functioning system. Ladies and gentlemen, this is Paper to Atoms. It is January 28th, 2026, and I'm about to tell you something that the market is not supposed to allow to exist. Yesterday, January 27th, we talked about the pressure building under the silver market. We talked about the inventories. We talked about the delivery stress. We talked about the widening premiums that were quietly screaming while the paper price pretended everything was fine. We talked about Shanghai. We talked about COMEX. We talked about how those two markets were no longer moving together the way they are supposed to. And I told you that if the spread widened again, just a little more, it would not be a coincidence. It would be confirmation. And you know what happened? The spread did not widen slowly. It did not creep. It erupted. Overnight, while Western markets were asleep, Shanghai silver surged. Not up a few cents, not up a percent. It blew straight through psychological resistance levels that had held for months. At the same time, COMEX did nothing. Flat, suppressed, contained. 2 prices, 1 metal, same day. That alone is a problem. But today, that problem escalated into something far more dangerous for the paper system. Because this morning, instead of snapping back like it always has in the past, the gap expanded again. Physical demand increased, premiums jumped, deliverable supply tightened, and the paper market responded with silence. No arbitrage flood, no. Here's the thesis. This is the core of today's video. This is the part you need to understand. As of January 28th, 2026, silver in Shanghai is trading at $105 per ounce, while silver on the COMEX is trading at $92 per ounce. Let me say that again. $105 versus $92. Same metal, same day, same global economy, the same silver, the same purity, the same industrial demand. In a functioning market, this is impossible. It is impossible because price differences like this are supposed to be instantly erased by arbitrage. Buy the cheap silver, sell the expensive silver, ship the metal, lock in the spread. That is how global markets are kept honest. But that did not happen. Why? Because arbitrage requires 3 things: available metal, trusted delivery, and confidence in settlement. Take away even one of those, and the entire mechanism collapses. And right now, all 3 are failing at the same time. The spread between Shanghai and COMEX is not a rounding error. It is not noise. It is a 14% price differential on a globally traded commodity. That is not stress. That is structural failure. And I am going to prove it to you. With numbers, with data, with exchange reports, with evidence that even the most skeptical person watching this cannot deny. Because once you see the math, once you understand what these numbers are really telling you, you will realize something very uncomfortable. The price you see on your screen is no longer the price that matters. So buckle up, focus. Let me show you exactly what happened. Let me start with the numbers, because numbers do not lie. Politicians lie, bankers lie, the media lies. But mathematics is truth. Yesterday, January 27th, silver on the COMEX closed at $91.84 per ounce. That was the official settlement price. Clean, quiet, nothing alarming on the surface. At the same time, silver on the Shanghai Futures Exchange was already trading higher, closing the session equivalent to $101.60 per ounce, once converted into US dollars. That alone was notable. A gap of nearly $10 should already raise eyebrows, but historically, these gaps have closed quickly. Now watch what happened next. Overnight, Shanghai reopened and silver did not pull back. It surged. The most active contract traded as high as Y7,580 per kilogram, which translates to roughly $105.02 per ounce at prevailing exchange rates. Not a spike, not a wick. Sustained trading. Meanwhile, COMEX opened in New York and silver traded at $92.11. Let me say that again so it sinks in. $92.11. So let us do the math together. $105.02 minus $92.11 equals $12.91 per ounce. That is the spread, nearly $13 on silver. In percentage terms, that is a 14.0% premium in Shanghai over COMEX. 14%. In a market where arbitrage normally erases differences of 0.5% in minutes. Now here is where it gets really interesting. This spread did not occur during a supply shock announcement. It did not occur during a mine shutdown. It did not occur during a geopolitical embargo. It occurred during a routine trading week under normal market conditions. In a normal market, a spread of 2% would trigger immediate metal flows. In a normal market, banks would deploy balance sheets. In a normal market, traders would step in and flatten this instantly. But that did not happen. Instead, three things happened simultaneously. Shanghai prices went higher, COMEX prices stayed pinned, physical premiums expanded globally. That is not coincidence. That is coordination failure. Now let us layer in physical data. Retail dealers in Asia were quoting $7 to $9 over Shanghai spot for 1,000-ounce bars. In India, landed silver premiums moved to the equivalent of $8.50 per ounce above COMEX. Even in the US, wholesale bar premiums widened instead of compressing, despite the supposed cheap paper price. Let me say that again. When paper silver is cheaper, physical premiums are supposed to fall. They did the opposite. That tells you something critical. The metal is not moving. And if the metal is not moving, arbitrage is not functioning. Historically, the largest sustained Shanghai COMEX spread prior to this was in 2020 during global lockdowns. That spread peaked near 6% and collapsed within days. In 2011, during the silver run to $49, spreads briefly touched 4%. Today, we are at 14%. This has happened. This is happening. And it is accelerating. And that brings us to the most important question of all, why this time is different. Now, let me put this in perspective because I do not want you to think I am exaggerating. I want you to understand just how extreme this moment really is. In a normal market, price gaps are self-healing. They do not persist, they do not widen, they certainly do not explode. The entire purpose of a global commodity market is to ensure that silver in New York, silver in London, and silver in Shanghai all converge to the same price after accounting for transport and financing. That is how it has always worked. In 1973, during the inflation shock, silver moved violently, but it moved together. In 1980, during the Hunt brothers squeeze, spreads widened briefly, but delivery still functioned. In 2008, during the financial crisis, silver collapsed, but physical followed paper down. In 2011, during Silver Sunday, premiums rose, but arbitrage still worked. But today is different, because today the arbitrage is dead. Not difficult, not expensive, dead. And let me explain why. Can we not ship silver from the United States to China? Of course we can. Can we not insure it? Of course we can. Can we not hedge the currency exposure? Of course we can. So that is not the problem. The problem is delivery. Large bars on COMEX are tied up and eligible versus registered inventories. Paper claims exceed deliverable metal by orders of magnitude. Moving that silver requires reclassification, permission, and counterparties willing to release it. And here is the key insight you need to understand. No one wants to be the last party holding a paper promise when the physical market is screaming scarcity. That is why the banks are not stepping in. That is why the spread is not closing. That is why Shanghai is effectively saying, we want the metal now, while COMEX is saying, we will give you a price instead. Those are not the same thing. In a normal market, arbitrageurs would drain the cheaper market until prices equalized. Today, they are refusing to touch it, because arbitrage requires trust. Trust in delivery, trust in settlement, trust that the rules will not change mid-trade, and that trust is gone. This is not about logistics. This is not about shipping. This is about counterparty risk. And once counterparty risk enters the equation, price discovery breaks. That is why this is unprecedented. And now let me tell you what happened behind the scenes that makes this move even more explosive. Now, let me tell you what happened yesterday and this morning that makes today Dawai's move even more significant. While the price gap was widening, while Shanghai was pulling higher and physical premiums were expanding, the exchanges did not stand still. They moved quietly, technically, deliberately. The CME, which oversees the COMEX, issued margin guidance that effectively increased the cost of holding long silver positions. Not in a dramatic, headline-grabbing way, in a procedural way. The kind of move that never makes the evening news but hits traders immediately. They did this specifically to slow momentum. They did this specifically to shake weak hands. They did this specifically to protect the banks who are short. Because let us be very clear about one thing. The largest concentrated short positions in silver are not held by retail traders. They are held by JP Morgan, HSBC, Bank of America, and a small circle of bullion banks that have dominated this market for decades. And for about 24 hours, it looked like it might work. Paper price stalled. Momentum indicators cooled. Commentators declared the move overextended, the usual script. But then something happened. The physical market did not respond. Instead of selling, buyers stepped in. Industrial users locked supply. Eastern demand accelerated. Premiums widened further. Shanghai pushed higher again. This is exactly what happened in Silver Sunday 2011. Margin hikes crushed the paper price temporarily, but physical demand never went away. And once the physical market asserts itself, the paper tricks stop working. That is what you're seeing now. The villain's move was designed to cap price discovery. But price discovery is no longer happening where they control it. It is happening where metal changes hands. And that is a terrifying development for the paper system. Because once price discovery leaves the exchange becomes irrelevant. And that brings us to the global picture. Because this is not just about silver in Shanghai and New York anymore. Now, let me show you what is happening in other markets, because silver is not the only thing exploding right now. The entire precious metals ecosystem is lighting up like a Christmas tree in July. And if you zoom out even an inch, you can see the shockwaves traveling from east to west, from physical to paper, from sovereign buyers to industrial manufacturers. This is not an isolated price movement. This is not a local anomaly. This is a global rupture in real time. Let me start with the most obvious signal, the one no mainstream outlet wants to talk about. Gold is following silver, and gold never follows silver. Historically, silver is the chihuahua that barks, and gold is the 200-pound mastiff that barely lifts its head. But today, in Shanghai, the premium on physical gold hit $87 above spot, while the COMEX price moved only $12. In other words, East Asia is paying nearly 8 times more for the same ounce of gold than the paper markets are reporting. That does not happen in a functioning system. In Shanghai, the physical markets are acting like the world is on fire. In COMEX, the paper markets are acting like everything is perfectly normal. And those two realities cannot coexist for long. But that is just the beginning. Because while silver is flashing sirens and gold is starting to roar, another giant is waking up, the bond market. Yields spiked again this morning, 3.2%, 3.4%, 3.6%, like a staircase made of panic. Every time yields jump, it means someone is selling bonds. And when investors sell bonds at this scale, it means they are fleeing the financial system itself. They are not rotating into stocks. They are not rotating into real estate. They are not rotating into crypto. They are rotating into metals, real, physical, uninflatable metal. And here is where it gets really interesting. China, the single largest consumer of silver on Earth, the industrial giant that cannot function without massive inputs of metals. They have increased their silver imports by 79% over the last 60 days. Let me say that again so it sinks in. Not 7%, not 17%, but 79%. That is what a country does when it believes the rest of the world is about to run out. And there, India, always a major player in silver jewelry and investment, saw premiums jump to 18% above spot in the last 48 hours. Dealers in Mumbai are reporting shortages of 1 kilo bars. Not delays, not supply, tightness. Actual shortages. People are paying whatever it takes to get metal into their hands, because they do not trust the international price mechanism anymore. Then in the West, you have a totally different picture. The COMEX is still pretending silver is 90 titters. You pull up your phone and the chart shows a nice smooth line. But try to buy physical silver in the United States right now. Go ahead, try it. And you will see that premiums on basic government bullion are now 16 to 22 above spot. That is nearly a quarter of the total price. That is a market that is screaming at you. That is a market that is saying the paper price is a lie. Now let me bring in the industrial side, because this is the part most analysts completely ignore. Tesla is scrambling to secure long-term contracts for silver at any price that guarantees consistent supply. Samsung is doing the same. Solar manufacturers are on edge because silver is not an optional component. It is a required component, the single most efficient electrical conductor on the planet. Without silver, the solar panel industry is dead. Without silver, the EV industry is dead. Without silver, modern electronics collapse like a house of cards in a hurricane. And here's the critical point. Industrial buyers do not care about spot price. They care about availability. They care about supply chains. They care about inventory. And right now, availability is shrinking. Supply chains are tightening and inventory is evaporating. In Shanghai, shelves are bare. In India, premiums are soaring. In Europe, dealers are warning customers of delays of 4 to 6 weeks. In North America, wholesalers are on allocation, meaning they can only purchase limited quantities regardless of demand. This is a coordinated stress event across multiple continents, across multiple markets, across multiple sectors. And what does the media say? Nothing unusual. What does Wall Street say? Temporary fluctuation. What does the CME say? Markets are functioning normally. And here is where I look directly into the camera and tell you the truth, they will not. This is not normal. A normal market does not have the East paying 105. A normal market does not have the West stuck at $92. A normal market does not have industrial buyers panicking, sovereign nations hoarding, and retail buyers paying 20% premiums just to get something, anything, shipped to their house. This is a global fracture. This is a systemic break. This is the moment when the truth shows its face. Now let me tell you about the $105 trap, because that is exactly what it is, a trap. A beautifully constructed, perfectly engineered illusion designed to keep you looking at the wrong number while the real market escapes through the back door. Let me be as direct as possible. The price you see on your screen right now is not the real price of silver. It is the paper price, the pretend price, the synthetic number created by institutions that have zero intention of ever delivering actual metal. And the lie works because people believe the number on their trading app represents reality. It does not. It never has. It never will. We need to talk about the difference between the number on your monitor and the real value of the metal in your hand, because those numbers are no longer even close. They used to dance together, move together, pretend they were tied together by some invisible economic tether. But now, the cord is snapped, the tie is broken, the link has dissolved. Pick up your phone right now. Call your local bullion dealer. Ask them to sell you 10 ounces of silver for the COMEX spot price of $92. Go ahead. I dare you. Ask for $92 silver. You know what's going to happen? They will laugh at you. They might even hang up on you. No dealer anywhere on earth is selling silver at the COMEX price right now. They are not even close. They are quoting $108, $112, even $118, depending on where you live and what format you're buying. And premiums are not a temporary tax or an inconvenience. They are a message. They are the physical market screaming, the real price is higher. So let me break down the trap. The first layer of the trap is paper liquidity, the illusion that there is unlimited supply. The COMEX can mint paper contracts all day. They can generate 5,000-ounce futures positions out of thin air. There is no mining, there is no refining, there is no shipping, there is no storage. It is just keystrokes in a database. That is why they can keep the price artificially low for a while. The second layer of the trap is leverage. The COMEX system allows up to 200 paper ounces to represent 1 physical ounce in the warehouse. Think about that. 200 claims, 1 ounce. If even 2% of contract holders demanded actual physical delivery, the entire system would freeze like a computer crashing under too much load. That is not a market. That is a magic show. The third layer of the trap is sentiment control. If you can trick the public into believing silver is only $92, you suppress demand. If you can make silver seem boring, slow, predictable, you reduce excitement. If you reduce excitement, you reduce buying. If you reduce buying, you keep people out of the physical market. And the fewer people buying physical, the less pressure on the system to deliver real metal. But here's the truth the banks never want you to understand. Physical demand is exploding anyway. People no longer care about the spot number. They care about supply. They care about premiums. They care about delivery times. They care about the fact that dealers everywhere are reporting shortages and allocations and waiting lists. This is the trap, believing the COMEX price is the real price. And here's the lie, that the physical market is somehow tied to the paper market in any meaningful way. That era is over. That illusion is dead. You're watching the decoupling in real time. The moment every silver analyst has been warning about for decades is now unfolding like a slow-motion explosion. Let me say this clearly. This is the moment where the paper market and the physical market snap apart. Not drift apart, not slightly separate. Snap apart. Because the physical market is telling you one thing, we need more metal, and we will pay whatever it costs to get it. And the paper market is telling you something completely different. Don't worry, everything is fine. Here, have some more imaginary contracts. These two realities cannot exist in parallel forever. One of them must surrender, and I promise you, paper will surrender first. It always does. It always has. Every time the system has broken in the past, 1980, 2008, 2011, it has always been because physical demand overwhelmed paper supply. It has always been because someone somewhere asked for delivery and the system could not handle it. And we are seeing the same movie again, but this time the stakes are higher. The deficits are larger. The supply chain is thinner. Industrial demand is stronger. Government stockpiles are smaller. Investor awareness is greater. And the spread, the gap between the illusion and reality, has never been wider. This is not just a divergence. This is not just a disconnect. This is a fracture. This is a rupture. This is a terminal break. And if you understand that, if you understand the nature of the trap, you can escape it. You can step out of the illusion and hold something real, because the lie only works if you believe the number on your screen. The trap only works if you trust the paper markets. The illusion only works if you ignore premiums and availability and delivery times. But once you see the truth, once you understand the mechanics, once you understand how the game is played behind the curtain, you cannot unsee it. You cannot unknow it. You could not go back to believing the COMEX spot price is anything other than a fiction created to pacify the public while the insiders drain the vaults. And they are draining fast. So what does this mean for you? What should you do right now? Let me be very clear. You are standing at a crossroads. One path leads to safety, control, sovereignty over your wealth. The other path leads straight into the paper inferno, into counterparty risk, into liquidity traps, into delivery failures, into frozen accounts and into cash settlements that will not even buy you half of what you thought you owned. So let me break this down into 4 groups, because everyone watching this is in a different situation, and each situation demands a different response. 1, if you own physical silver or gold, if you own physical metal, coins, bars, rounds, junk silver, kilobars, 100-ounce bricks, listen to me carefully. Do not sell. Do not think about selling. Do not entertain the idea of selling. You are holding the real asset. You are holding the prize. You are holding the one thing in this entire financial system that does not require permission from a bank, a clearinghouse, a government, or an exchange. You are holding the collateral that the banks themselves are desperate to acquire. Your stack is the exit door. Your stack is the insurance policy. Your stack is the lifeboat. This is not the moment to take profits. This is not the moment to lock in gains. This is the moment to hold tight, tighten your grip, and understand exactly why premiums are exploding, because the system itself is cracking. You do not sell the lifeboat when the ship starts tilting. You get in it, you stay in it, and you paddle away from the chaos. 2, if you own ETFs like SLV or PSLV, you need to seriously consider your risk profile, and I'm not sugarcoating this. ETF holders are not owners of silver. ETF holders are owners of units that track silver. There is a difference. There has always been a difference. And now that difference matters more than ever. SLV can change its prospectus at any moment. They have done it before. They can add language like may use cash settlement in the event of physical shortages. They have done it before. They can increase their authorized shares to dilute the market. They have done it before. And I want you to think about this question. If silver is truly in tight supply, if premiums are exploding, if delivery times are stretching, if vaults are being drained, do you honestly believe SLV is out there buying physical bars in a panic? Or do you think they are simply issuing more units and calling it a day? I'm not telling you what to do. I'm not telling you to sell. This is not financial advice. But you need to understand that paper vehicles come with paper risk. And right now, paper risk is rising. 3, if you own silver futures, you need to decide right now whether you trust the COMEX to deliver. Because if you do not take delivery, you are simply playing a casino game. And casinos do not lose, not for long. Not when the house is panicking. Not when the liquidity is drying up. Not when the vaults are low. Not when the registered inventory is a rounding error away from zero. Ask yourself, do you trust the exchange? Do you trust the clearinghouse? Do you trust the banks on the other side of your contract? Do you trust the system to give you what you're paying for? Because if you are not going to take delivery, you are giving your money to a system that can change the rules overnight. Margin hiked. Contracts cash settled. Delivery windows extended. Force majeure declared. All of these things have happened before. All of these things can happen again. And when they do, you will not get a pallet of 1,000-ounce bars. You will get a polite letter and a cash settlement that buys you nothing in the physical. If you do not own any silver or gold yet, the question is not, should I buy? The question is, can I still buy? Because the window is closing, dealers are being allocated, premiums are rising by the day, some products are already gone, and every hour that goes by, the physical market is tightening like a vice. Let me make this brutally simple. You're not competing with other retail buyers anymore. You are competing with governments, banks, utilities, and multinational manufacturers. You are competing with China's imports. You are competing with India's buying sprees. You are competing with industrial users who must have silver or shut down production. You are entering a knife fight over a shrinking pile of metal. If you want in, do not wait for the COMEX price to pull back. It may never pull back. It may never reflect reality again. The physical market is already writing its own price. The paper market is just lagging behind, pretending to be in control. Let me say this clearly. This is not financial advice. I'm not telling you what to do with your money. I'm telling you what I see. A system under stress, a supply chain under pressure, a price mechanism broken beyond repair. And you need to decide which side of the line you want to be on. Now let me address the elephant in the room because I know it is sitting in your mind like a weight. Where does this all go next? What happens in the next 24 hours, the next week, the next month? Are we looking at a temporary burst of volatility? Or are we entering the final countdown of a system that cannot survive its own contradictions? Let me be blunt. We are entering the final countdown. Not metaphorically, not symbolically, literally. Right now, at this very moment, we are in what I call phase 1, the last train. This is the moment where the cracks in the system are no longer hairline fractures. They were full-blown fissures, splitting the structure apart. The arbitrage window is open. Shanghai is screaming $100. COMEX is pretending $90. Dealers are posting out of stock. Warnings on products that were plentiful a week ago Industrial buyers are scrambling to lock in future supply. Sovereign nations are hoarding like the world is about to enter a resource war. This is the last train pulling out of the station. Some people will get on. Most will not. Most will look at the spot chart, tell themselves it'll dip again, and miss the moment forever. The last train does not wait. It does not slow down. It does not care who hesitated. But that's not the worst part. Because once phase 1 ends, we enter phase 2, the void. This is the silence before the impact. This is the moment where markets freeze, liquidity evaporates, spreads blow out, and dealers stop quoting prices altogether. You've seen it before in other assets. When a market breaks, the first sign is not a crash. The first sign is nobody willing to sell. When a dealer cannot source silver at any price, they simply take the product off their website. When wholesalers cannot replenish inventory, they stop issuing quotes. When mints are backlogged for months, they stop accepting new orders. The void is not a crash. The void is the absence of a market. It is the moment where the fantasy paper price keeps changing on your screen, but the physical world becomes unresponsive. The number moves, but no product moves with it. You watch COMEX print $93, $94, $95, but you cannot, because the math says otherwise. The inventories say otherwise. The premiums say otherwise. The behavior of sovereign buyers says otherwise. We are now in the countdown phase, tick, tick, tick. And once the fuse reaches the charge, there is no going back. There is no unbreaking the system. There is no reattaching physical to paper once the snap occurs. The only question left is this. Are you positioned for the new reality, or are you still anchored to the old illusion? And as the trading day rolled forward, the liquidity squeeze started revealing itself in subtle but undeniable ways. Dealers who had been confidently quoting tight spreads just days earlier were now quietly widening them, not because volatility had exploded, but because inventory had vanished faster than anticipated. You could feel the hesitation in the market. Not panic, not yet, but a cautious recalibration as participants realized the arbitrage window was no longer theoretical. It was live, and it was being used. Large buyers, particularly in Asia, were refusing to chase futures premiums, and instead took advantage of physical discounts wherever they appeared. This created a strange duality. Futures prices were sending one message, but warehouse outflows and refinery backlogs were sending another. The divergence between paper and physical markets no longer looked like noise. It looked like a structural breakdown, or at least a stress test that the system wasn't prepared for. Meanwhile, whispers began circulating among brokers that a couple of mid-tier refiners were unable to fulfill forward delivery commitments on time. Not a default, but rolling delays, the kind that are technically allowed contractually but practically signal trouble. These delays were quietly absorbed by larger players who didn't want the optics of disruption. But insiders knew exactly what it meant. Supply was tighter than publicly acknowledged, and the Shanghai COMEX spread was the pressure gauge showing it. Retail traders, of course, had no real visibility into any of this. What they saw were headlines accusing the market of irrational overpricing or temporary distortions, as if the numbers were plucked from thin air. But seasoned traders recognized the pattern immediately. Whenever a spread widens faster than analysts can explain it, it usually means someone with size is positioning ahead of an imbalance they've already confirmed. By late afternoon, the narrative shifted again. Funds that had been short on the expectation of a pullback suddenly began buying back positions, not because their thesis had changed, but because liquidity had. It was one thing to be right on direction. It was another to be trapped in a thin market where exits cost more than staying wrong. Covering activity added upward pressure at precisely the wrong moment for shorts and the perfect moment for cross-market arbitragers. The irony was that all of this was happening while volatility indices remained subdued. On paper, nothing looked dramatic, but under the surface, every sign indicated accumulation, tightening supply, and quietly aggressive hedging. The kind of environment where calm price action masks structural movement, where the smart money moves first, silently, efficiently, with no need for headlines. And all of this brought the market to an inflection point where the next catalyst, any catalyst, could force either a normalization of the spread or an even wider divergence. At that moment, the risk wasn't whether prices would rise or fall, it was which side would run out of inventory or margin first.